So Engine Room Central, we're going to pretend today that Treasury is the center of the bank for the purposes of the conversation we need to have. Victor will tell you the client is the center of everything we do, and the client is the center of the bank, and he's right, and that's true. But we're going to talk about Treasury as the engine today, and I think that if you're talking to Victor and you tell him that I was speaking about Treasury as the center of the bank, just tell him it was Peter Levitt's idea. Okay, enough of the jokes. We're going to talk about Treasury's role as the engine of the bank, and we're going to try to translate that into some of the futuristic concepts we've been talking today, and about how future changes may impact the role of the bank's engine in terms of Treasury's role. So we'll start with Treasury's mandate. Treasury has a broad mandate, but part of it that's relevant for today. And I apologize for the slides. You'll see that these are typical internal banker type slides. They're not the pictures and the few words. And don't try to read everything. If you really want the slides, I'm happy to give them to you. But I'm not going to read it all. I'm just going to touch on a few things. So the part of the mandate that I want to talk about is managing the balance sheet resources and managing the balance sheet risks. So balance sheet resources, by and large, in terms of what we deal with, capital and funding, balance sheet risk being interest rate risk, liquidity risk, FX risk, peripheral risks, pension risks, things like that. So in terms of managing those resources and risks, we've got three broad categories here that I'll touch on. Funding and liquidity management. There's an old saying in liquidity, if you have too little liquidity as a bank, you will die fast. If you have too much, you will die slow. Getting this just right is a very important concept for a bank, and measuring it, managing it, making sure the resources are there. It's an ongoing and active area of engagement for Treasury, yet and critically important for supporting the business unit functions of the bank. Performance measurement and resource allocation. So. One of the senior leaders at CIBC once told me, you get what you measure. And that was after I just joined Treasury. And as I've been through my years in Treasury, it's a very poignant saying. And measuring and managing properly is a key component in arriving at the result that you want to arrive at. So, measurement and management includes balance sheet optimization, strategic deployment of resources, effective transfer pricing of those resources to the business units so that you can achieve proper outcomes. And then structural interest rate risk management. And this is, funding liquidity is a big one, but structural risk management is really a big component of if you're thinking of Treasury as an engine. Treasury has manages billions and billions of flows of interest rate risk, fixed, floating, short, long, and where the bank ultimately gets positioned against changes in interest rates has a huge effect on performance. You can position yourself for rising interest rates and at the same time sacrifice accrual P&L in terms of an interest rate position. You can position yourself for no changes in interest rates, create a profitable accrual P&L position, but then really miss out if interest rates change. So the structural interest rate position, people refer to it in the asset liability management function, huge component of what Treasury does in terms of guiding the P&L and net interest income performance of the bank. Also within this frame as well is investment of excess liquidity, determining credit risks, determining duration of investments, short or long, can have a big impact on both your liquidity and your economic performance of the bank. So I think one of the reasons that these three components can really be discussed as a central function is lots of flows within the bank, lots of businesses, lots of different contracts and business arrangements that the bank has entered into. And if you manage each of those if you manage these components at each individual business, you'd end up, you know, over hedging, under hedging, things like that. So there are lots of puts and takes that each of the business units and contracts that the banks enter into that are aggregated in Treasury. And to the extent you can offset those puts and takes into a consolidated funding position, a consolidated liquidity position, or a consolidated structural interest rate or FX position, there's a lot of efficiencies that are gained there. And it can only be done centrally because you need to bring all those together to create those offset positions that give you the most efficiency. So that's sort of the components of Engine Room Central that Treasury manages, and they're incredibly important to achieve the long-term objectives of the bank. Here's a nice banker slide for you. The balance sheet resource management challenge. So on the right, we have value creation, which we are all trying to strive for. And I'll highlight one of the buckets, total shareholder return, TSR. We've got a few components that's broken down to, but that's what we're trying to achieve. But we have to start on the left with the optimization challenge. Banks have a huge number of opportunity sets in front of them in terms of businesses they could grow, new businesses they could enter, businesses that they could shrink. But all of those opportunity sets are bounded by constraints. We all know about capital. We've got both risk-based capital. We've got leverage capital, which is not risk-oriented, but sort of governs the total size of your balance sheet relative to your equity. And then we've got liquidity and funding. And in the liquidity funding mix, we've got a number of internal constraints that we impose upon ourselves to guide us through the too much liquidity, too little liquidity array. And we've also got a number of ever-growing regulatory constraints that are forcing us to adjust our liquidity practices according to benchmarks that are established by the regulators. We put all together, it comes together in the center. So balance sheet optimization, as we talk about Treasury as the engine, we're looking to achieve returns through the cycle. We're obviously looking to achieve EPS growth. That drives the one of the boxes on the right, the valuation multiple. But we also have balance sheet constraints, as I've talked about a minute ago. But we also have resiliency. And resiliency is becoming a more and more important factor facing banks as we've gone through the liquidity crisis, as regulators are focusing on it. Resiliency generally costs you. Resiliency generally means more capital to deal with crises. Resiliency generally means more liquidity to deal with crises. So it's a balancing act. And that balancing act, you know, we look at it as an optimization exercise, an opportunity where we, you know, use our analytics, use all the flows and data that we see to drive capital deployment and resource deployment in order to create the value chain that we see on the right of the slide. We have seen the regulatory framework that is evolving, although not as evolving as fast as many would like in terms of a global consistency, is driving to create global consistency amongst banks' balance sheet and banking practices in terms of these resources and constraints that live in the center of the bank. So that is helping globally, you know, pricing and creating demand for products that banks enter into. However, it is great. I'll talk to you a little later. It is creating dead money within the system that is difficult to redeploy in terms of regulatory constraints. There's always a dynamic tension here between these concepts, and you know, Treasury, we do the work, we do the analytics. One of our challenges is these are very complex concepts when you dive down into them, and one of the challenges is to have the broader bank buy into optimization strategies, have senior management understand and buy into optimization strategies that lead to different outcomes in terms of strategy. Just a quick slide on it's a simple table on what do Canadian bank balance sheets look like, and some of the concepts that I talked about earlier. Highly liquid, client-driven balance sheets. You can see that a couple of points we've spiked out on this is one of the things we watch closely is our unsecured funding levels in terms of our resource allocation. We have, and this is an average of the 6 Canadian big banks. We have 178% coverage of liquid assets over wholesale unsecured funding, and then we have 75% coverage of deposits over loans. So that's a typical Canadian picture, and we'll talk a little bit more about how that works into the changes that we'll talk about. Funding strategy and sources. I'm funding a liquidity guy. Used to have a capital management mandate, but that's gone to somebody else now. So capital's boring, funding is exciting. Capital is pretty steady. Funding is dynamic, and funding as a resource certainly needs to be run centrally by a bank. Multiple funding avenues of similar products is not a good construct for the bank. So we in Treasury run the wholesale funding operation of the bank. We work with our deposit gatherers to make sure that they're doing things that are strategically in line with the bank's objectives as well. But the real, you saw on the slide before, there is a gap between deposits and core loans, and we fill that gap in Canadian banks with wholesale funding. So it's critical for us, and it's critical for the smooth running of the engine that we have multiple wholesale funding sources. You can see the list of them there, multiple products across multiple geographies. And one of the things we consistently strive for is more diversification. You can see on the bottom right, we consistently strive for new geographies, new instruments, new investors, and new tenors. So critically important, again, this is a bit of the gas that goes into the engine, so critically important for Treasury to manage as we go forward. A little more information about Canadian banks' wholesale funding profile by geography. Canadian banks are very good at going around the world to get funding, and that diversity serves us well in good times and in bad. So the regulatory environment, critically important to the components of running the engine of the bank. We're under a constant, ever-increasing flood of new regulation on capital, new capital rules, new capital thresholds, regulators around the world and in Canada prescribing new regulatory rules for calculating risk-based capital. And the same goes for liquidity, and liquidity's even been more lately. As a result of the Basel III initiatives, we've got the liquidity coverage ratio. And while it's difficult sometimes to manage and it's a complex calculation, I would say it is good to have a liquidity ratio that is consistent across the banks. And it would be good to see that liquidity ratio be consistent around the world. We're not there yet, but it is a good thing. We've also got the net cumulative cash flow, which is a local requirement by OSFI. We are going to have the net stable funding ratio, which is a longer term liquidity ratio than the LCR. But you can see that when you put this in with all of our own internal constraints, we have internal liquidity constraints, we have internal wholesale funding limits, we have bucketized constraints that we abide by. Liquidity is becoming very complex and many constraints to balance against, and it's a large part of what Treasury does as part of being the center of the bank and the engine. Again, other things that are coming on the regulatory side, we've got total loss absorbing capital. It's just been issued, the guidelines in Canada for comment. Derivatives reform incoming, and more and more constant residential mortgage underwriting. So all of these regulatory issues that are coming up and the pipeline of regulatory change that's coming really does change what we do, and it really does change how we operate in the center of the bank in terms of what it does is it's constantly changing those constraints that we described that affect what opportunity set the bank can engage in. So looking at the future, I just want to talk, there are a bunch of pages here, but I just want to talk about a couple of things. So the concepts that I've described for you for Treasury, about balance sheet resource management and optimization, those concepts are hundreds of years old. Banks have been doing that for years and years and years. How do we use technology to get better at it? Yes, we do. Make it faster. But those concepts have been around forever. And although we've talked, the last session was a great one, we've talked about a lot of things that are going to change banking in terms of the digital changes, technology changes, the way things are being done. I'm going to try to keep my comments to how they affect the center of the bank. And I don't really think they will change those core concepts that I described. I will go into we'll make some comments about how I think they will change at the edge, but I don't think the concepts themselves will change in terms of how we do things. I'm going to talk about digital ledger technology or blockchain, or there are a number of names for it. I think that there's we've got an example in here of a bank that has loans, it has deposits, it has other funding, and I think that one of the things that we're seeing happen as a result of, we'll say as a result of liquidity changes, and you've heard lots of stories in the U.S. about this as well, is that a number of the regulatory liquidity changes have deemed certain cash flows, certain deposits, and certain liabilities that come into our bank as not useful. We're deemed to assume they're running off at the first sign of trouble, and therefore we can't really put those dollars back into the economy in terms of loans to businesses, loans to consumers. We'll generally call those non-operating deposits. We refer to them in our shop as hot money. It's going to leave at the drop of a hat. I think that as a possible change that's coming, what could something like blockchain do? CIBC is part of a group that's working with other banks and with a number of central banks around the world to investigate ideas about what blockchain could do. And one of the ideas that is on the table is, for this money that the regulators and others have deemed to be hot money, or not that useful, or not money that we can redeploy into the economy as an intermediary, can we have a more efficient way of deploying that in the economy? And the way that it's thought that might happen is, perhaps we could work with the central bank to say, let's have those deposits bypass the banking system. Let's have those deposits sit with the central bank in and of itself. And to enable that to happen, you need crisp technology. And the blockchain distributed ledger safe transaction system concept, in partnership with the central bank and possibly central banks around the world, could match up intermediaries of deposits that are no longer great for banks with those who want and can do something with those deposits. So what does that do to Engine Room Central? It would shrink our balance sheet by a meaningful amount. It would free up leverage capital, possibly free up risk capital. That's what it might do for the bank. We could become more efficient. We could use those same concepts as I described for optimization, but think of a more nimble bank that is able to better deploy its resources in terms of real money into the economy. One of the other things that would happen as well, I think, is that the development of such a technology could free up banks, to have that money away from their balance sheet. And I think one of the key components of that kind of technology, as I see it affecting the Engine Room Central of the bank, is faster, better settlement procedures. And that's as we have many custodians, as we have many clearing agents, as we have many central banks, as we have many securities depositories within our global economy, there's a complicated web of settlement, collateralization, T+1, T+3, T+5, different conventions around. I think that one of the things that the blockchain could do, or distributed ledger technology, or utility settlement coin, or whatever phrase you want to use, it could really reduce settlement time. It really could improve transaction transparency between participants. And it could really, again, back to the bank, free up collateralization requirements on trades. As you know, when trades are settled and money flows and net amounts are exchanged within the Canadian and other financial systems, the safety is all on the back of collateralization. The safety is, you want to make a payment, you want to have a central clearer make a payment for you, post the collateral to make sure that if something happens, there's a backstop there. One of the real benefits of a safe, secure, transparent, fast transfer technology is it could free up a lot of collateral and settlement time for banks operating in the financial system, and quite frankly for clients operating within the financial system. So that's a that's a big opportunity, and there's work being done on that. I want to talk about one other one. I've got a bunch more slides here, but I'm not going to go through them. I think that I really enjoyed Eric's comments on machine learning. I certainly learned something about machine learning for those comments, but when I think of machine learning and AI, Eric listed the 4 parameters or conditions or whatever word he used to describe that, to where machine learning could be successful and could be implemented. And when I go back and I think of what do we do in Engine Room Central, I think of we are always trying to predict depositor behavior. We have reams of data. We have it by business unit. We have it by sub-business unit, right down to personal accounts. And it's not easy to process and assimilate and come up with predictive behaviors on deposit patterns currently. And I think when I heard Eric describe what could be achieved through machine learning, I immediately, deposit behaviors, perhaps even asset pattern behaviors down to an individual client level, certainly structural interest rate risk management in terms of future flows. How does it affect our structural interest rate risk? How should we positioning? How can we predict those kinds of things? Certainly, as we go about hedging our FX position as a result of our global operations, certainly we could use that. And I think tying it all together, I think AI, machine learning, perhaps even deep learning, I think those concepts are a fertile ground to apply to banks. And I think if we can do it properly, there's real opportunity to increase the efficiency of banks' balance sheets, to free up more resources for deployment into the economy, and just make the banking system and, quite frankly, the economy a lot more efficient. I think I've droned on for 20 minutes, so in the interest of time, I think I'm going to leave it there. So I think I've tried to convey to you a little bit about why Treasury is the engine room central of the bank, and a couple of concepts about how I think the future of that engine might be changed by technology and or the concepts that are emerging that we've talked about all day. So I'll leave it there and see if there are any questions.
Okay, so I'm going to ask you the home capital question. So as the treasurer, from your perspective, what was the flaw in Home Capital's business model? And apart from the ethical issues, how are they fundamentally different from the big Canadian banks?
I think their asset side is similar in terms of product. Mm-hmm. They're heavily mortgage based. Their origination channel is a little bit different. It's broker based. However, I think the real difference and distinction lies in their liability base. So I think that again, too little liquidity, too much liquidity. Depending how you get it, matters. And I think home capital showed us that. Highly broker originated deposits that were demand deposits. Now, demand deposits are great. There's nothing wrong with demand deposits. It's the maturity transformation by which we take $100 billion of demand deposits, assume $70 billion are going to stay throughout the cycle. We can put those $70 billion into longer term mortgages, and we feel pretty safe about it. The difference with home capital is they don't have that. They source those indeterminate deposits, those demand deposits that could leave every day. They do have fixed term deposits, and that's a good thing. Those can't run on you. But their sourcing of those demand deposits was through a broker network. I don't think they had the relationship with the client. I don't think they had. They don't have a multi-dimensional product with the client: mortgages, credit cards, deposit, car loan, wealth management advice, branch on the corner, someone they know, and I think all that matters. It's interesting to hear the conversation today about how it seems that that's all going to get replaced. I don't think it's going to get replaced, and I think home capital shows us that. And I think it's to answer your question, the distinction of home capital versus Canadian banks is on the liability side.
Okay. So what are you doing with cryptocurrencies like Bitcoin or Ethereum? Are they part of your work, or do they just present risks for banks?
They're not entirely part of our work. I think we are working on more the blockchain digital currency fronts for the reasons that I described. We're keeping an eye on cryptocurrencies as a potential replacement or way to disintermediate banks from the system, but we're not entirely focused on trying to be part of that.
So you're not going to be holding Bitcoin anytime soon?
Not to my knowledge.
Okay. Any? Yep, over here, please.
Since the financial crisis, to what extent, or how's the attitude of regulators changed with regards to taking a view on either rates or things like that? Have they become more open to it, less open to it? Just broadly. Broadly
speaking, I would say the view of regulators on something like rate risk hasn't changed. They're not coming into us and saying, you must do this, you must do that, but they are looking at it more carefully. They are monitoring closely. As with everything we do, we are having more and more discussions all the time about rate risk, liquidity risk, FX risks, all of those things. And I think that one of the things that I've experienced in the 5.5 short years I've been in Treasury is that there's more and more monitoring of it. And from the regulator's perspective, they're very interested in more and more internal governance over it. So they're not telling us what to do about it, but they want to see that we're monitoring it, we're discussing. They want to see that senior management understands it, and they just want to make sure we're on top of it.
So we heard a lot about regulations this morning, and particularly with the private Bancorp acquisition, your exposure in the U.S. is going to become bigger. How are the rules in the U.S. complicating the job of a treasurer of a Canadian bank?
Not really so much. I think that that's the private bank is who we've merged with will be, it's a core focus of our strategy. I think that one of the big things we're going to get out of the private bank is they're a great asset origination shop, and they have a great opportunity to originate high quality term and indeterminate deposits. We have had in our U.S. region a relationship, governance relationship with the Fed already in New York. We've had a relationship with the New York State Department of Finance that issues us our branch license. We are familiar with those concepts, and those concepts are the same concepts as apply to private bank. Their regulators are primarily the Chicago Fed and the Illinois State Department of Finance. So we're comfortable with it. We recognize what it is. One of the issues is, and this will be a good problem to have, is where we raise deposits and where we raise wholesale funding now, we can kind of send it anywhere in the bank in the construct we have now. where you have a highly regulated bank in the US who becomes a very successful deposit gatherer, it's hard to get that money out and deploy within a bank elsewhere. So if private bank gets to the point where they're gathering too much high quality deposits, that might be an issue we have to deal with, but that will be a good problem to have. So, but that's kind of the only one that we see from a regulatory and operational perspective.
And last question, so which of the Basel regulations would you like to see go away? Which one do you think is the one that causes you the most inefficient from your perspective?
I think I'm not an expert on this, but I think the capital rules on mortgages that are coming down, the floor rules and things like that, that's highly disruptive. The other one that's coming that's not here is the NSFR. I think the NSFR is going to be quite disruptive. The NSFR, and liquidity for a long time has been about survivability. Liquidity has been about liquid assets. How long can you survive? Is it 60 days? Is it 90 days? Is it 180 days? What is it? And under a very severe crisis. With the NSFR, the regulators are starting to creep into, I'm telling you how to fund. I'm not just governing your survivability. I'm telling you, you must fund longer and for these asset classes and under many circumstances. Not sure I agree with their assumptions. So that is one that's going to affect the funding profile of the bank in a way that I think is less productive than other regulations.